Hey there, contentious investor again. Today we're going to be taking a look at overcollateralized lending, an incredible strategy utilized by the wealthy in order to legally avoid paying taxes. Before I get into explaining that, however, I'll issue the standard disclaimer. This is for educational and entertainment value only, and since I am not a financial advisor, it should not be taken as financial advice. Additionally, you should always do your own research and not blindly follow the opinions of some stranger on the internet. If you have any questions, give me your worst in the comment section below. With all that out of the way, let's get back to overcollateralized lending. Wealthy people tend to gain the vast majority of their wealth through capital appreciation. Jeff Bezos and Elon Musk didn't make their fortunes from their salaries after all. Instead, they allow their money to work for them, as the stocks they own increase in value while they sleep. This is a major reason why the wealth gap has grown so far as of late. The stock market is growing a lot faster than salaries, so assets compound more quickly. Therefore, people who own assets will grow their net worth faster. Wealthy people also do not like paying taxes. None of us do, to be fair, but they have better ways of avoiding them. Most of their wealth comes from their investments, so all they have to do is find a way to not sell for a capital gain. Imagine you have $10 million invested in a general stock market ETF, and you really want a new yacht that costs $1 million. You sell the shares, you get hit by the capital gains rate at a rate of 15%. And lose exposure to those shares going up in price after you sell them. So instead, you opt to go and get an over-collateralized loan on those shares. Since those shares are so safe, and you're a rich person with other assets, the bank knows that it's always going to get its money back. Therefore, it gives you a loan at a 1% annualized interest rate. The carrying cost would potentially pose a problem for you, except for the fact that the dividends cover both the interest payments and taxes. In essence, you just got to sell your shares without paying taxes, while still having exposure to price appreciation and still receiving the remaining portion of the dividends. Unfortunately, retail investors are simply unable to do the same thing. They not only lack the assets necessary to live off the principal, but it's simply also a bad value proposition for the bank. Retail investors simply aren't worth their time, even if there was perfect security against a margin call. In the last couple years, however, cryptocurrency lending platforms have sprung up, allowing those with cryptocurrency assets to delay capital gains tax in the same way that the wealthy investor does. Imagine that in 2013, you bought a Bitcoin for $100. To make the numbers easy, let's say that Bitcoin is currently $10,000. An unexpected expense comes up, such as your car needing a $1,000 unexpected repair. You have three options. The first is to put it on your credit card, but generally that is ill-advised, as it will take you a while to come up with the $1,000 to pay back, plus the interest that you've accrued. Option 2 is to sell the Bitcoin. The problem is you have to pay trading fees, wait for a large transfer from the exchange to the bank to clear, and you realize a capital gain of $990. Assuming you live in the United States, you'd be hit with a 15% tax on long-term capital gains, and would thereby have to pay $148.50 in taxes. To reacquire your original 0.1 Bitcoin that you sold, assuming the price that stays stable, which is a big assumption, you would have to pay $1,150 plus more trading fees. If the price goes up, which is kind of the point of being invested in, you lose exposure to that move. Or you could do what the rich investor did for his yacht. Take out an over-collateralized loan on the crypto. You would take out a loan against the Bitcoin and receive the cash you desperately need. When you get enough money to pay back the loan and the interest, you do so. And unlike using a credit card, the interest accrued will be minuscule due to the much lower interest rates on over-collateralized loans. Without being subject to a credit check, you can get the loan to repair your car and pay it back at your own pace. Best of all, you keep your exposure to the upside potential of Bitcoin, since you get it back when you pay back the loan, all without paying a single penny of capital gains taxes. While delaying capital gains taxes is the main reason to take out one of these loans, others do exist. Crypto miners regularly use loans to be able to pay for operational costs while still having exposure to the upside on coins they mine. Sometimes loans are used to give leverage to a coin by using the money received from the loan to buy more of the crypto, often repeating this process several times. Among numerous other uses, people have also used over-collateralized loans to diversify a crypto portfolio by using the money received to buy other cryptocurrencies. Crypto loans are not without their risk, however. Counterparty risk is a major one. You choose to use a centralized service to facilitate the loan. If the service loses your crypto due to poor security, not liquidating loans correctly, fraud, or for any other reason, you are simply out of luck. For a decentralized service, smart contract failure is a huge risk, as seen by the numerous exploits that have been pulled off as of late. The other major consideration is what loan-to-value ratio to use. The higher the loan-to-value, the higher the risk. However, it lets you extract far more capital from your collateral. Industry standard is to use a 50% LTV ratio, so I'll use that as an example. You have a Bitcoin worth 10K, so at that ratio you'd be able to take up $5,000. When Bitcoin gets pretty close to $5,000, you get liquidated, meaning your Bitcoin gets sold and you get none of the proceeds. This is an utter disaster, as you just realized the capital gain and were forced to sell, probably during a flash crash for a bad price. Therefore, you should always use the lowest loan-to-value ratio available, and 25% is recommended if you're taking out a loan in order to temporarily extract equity. If you are planning on taking an over-collateralized crypto loan, the best option right now is far and away Celsius. They're one of my favorite crypto companies due to their extreme transparency and honesty and excellent rates. They utilize cold storage, the industry standard for security. However, they've never lost a penny of user funds and have pledged to use their own money to make customers whole if they did. I personally use them and love their services. At the moment, they're running 2 amazing promotions in order to attract new customers. The most important one is that they are offering crypto loans at a steeply discounted rate. They are offering a 1% APR for loans with a 25% LTV ratio, which is the ratio you should probably be using anyways. They even allow the term to be up to 3 years in length, which I absolutely recommend taking advantage of. If nothing else, it's a free way to short the dollar. Almost free, that is. If I was giving advice, that is, which I am not, because this is for educational entertainment value only, and not financial advice. Link in the description is the offer. There are other offers significantly less impressive, but it is still a good value. For new customers, they are offering $20 who use a referral link if they hold at least $200 of cryptocurrency in the wallet for 30 days. That is literally just free money. A 10% yield on your money in a month is not too shabby. Link to that will also be provided in the description below. I also could have thrown you guys a referral link that would have given me $50 and you guys nothing, but that's kind of a scummy thing to do. If you think I'm in this for the referral links, literally just get some randos off the internet, since it's still free money for you. The real question is, where are crypto loan providers getting the money to pay people who deposit collateral? In my next video, I'll explore crypto savings accounts and show you how you can get nearly 50 times prevailing interest rates on US dollars by lending to people taking out these loans. If you want to take advantage of the strategy, links are in the description. If you have any questions, throw them in the comment section below. If you have any feedback, also let me know that. If you got any value from this video, you can do the usual stuff with the algorithm, blah 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 blah. Like, subscribe, etc. etc. Other videos should show up in the end card, so feel free to watch those. This has been The Contentious Investor. Until next time.